everyone for coming to the ACCE, Association of Chinese Canadian Entrepreneurs Business Forum 2012. On behalf of ACCE, we welcome you all, and today we have a full program here. By my side is Edward Gill, the director of ACCE and also a co-chair of this event. I myself is Alice C., the VP of ACCE, also one of the co-chair of this event.
There are some great door prizes to be drawn at the end of today's session, including an Android tablet sponsored by Samtec, a free weekend stay in Hilton Suite with complimentary breakfast for two, and the third gift is $50 gift card from Esso gas station. So remember to drop your business card, your ticket stub, and also complete your survey at the registration booth outside. We ACCE value your comment to make our future events even better. Please note that the winner must be present in order to receive the prize.
Okay, so remember, stay till the end of it and come back here, even you were in the exhibition booth or in the council in the other critical session. At the end of the day, come back here in order to win the prize. Okay, now today's program, the purpose of our program here is to provide a platform to the new or experienced entrepreneur to share their business skills and expertise. And every year we have this function to invite all the award winners here. And today's agenda includes an economic forecast by RBC economist. And also we have successful Chinese Canadian entrepreneur award winner to share their wonderful experience of their success stories. And we have successful entrepreneur, businessmen, and professionals in the critical session to tell you some of their knowledge and skills. So stay tuned. We have a full day's program, and don't forget to visit our trade show there to pick up your useful information. Without further ado, maybe can I introduce our president of ACCE, Mr. Alan Kwong. Alan Kwong is also the president of the Farm Inc. Technology, and also the Best International Business Award winner of 2005. Mr. Alan Kwong. Thank you.
Well, first I'd like to welcome each and every one of you being here this afternoon, even though with this challenging weather that we saw yesterday and what's coming later on today. The first order best, I'd like to thank our sponsors, our title sponsor, RBC, our airline sponsor, Cathay Pacific, and our supporting partner, Ming Pao, for the support for this business forum. Today, you'll hear about the economist from RBC, Paul, to talk about the challenging economy. I remember barely 6 months ago, he was here talking about the challenging times, and I thought it was over. And today, we are again going to listen to Paul to talk about the challenging times that we are facing. For this coming, well, I don't know for how long, especially looking at what the market was happening in the world yesterday. But it's always, look at this, it's always amazing. We look at it's trying to forecast what's going to happen in the future. We know exactly what happened in the past, but what is going to happen next day, next week, next month, and next year is always challenging. And today, you will hear some of these successful entrepreneurs. Now it's like in the past, they are successful winners. There's no dispute about that. But you will hear each and every one with their own story. When they were facing uncertain, challenging economic timing, and now they weather the up and downs and the storms of during the course when they're building the successful business. And I hope today you'll hear about some of the distinguished speakers to talk about how to get financing, how to do business with big companies like Walmart or the Parapan Am Games, and also how to get government help that would not cost you, and also in some way specific ethnic markets, how do business with the ethnic markets. So stay tuned and enjoy the rest of the day, and hope some of you who is as the aspiration to becoming entrepreneur, take notes, and hopefully this will help you to becoming successful entrepreneurship. Thank you.
Now, the event would not be successful without the support of the sponsor, RBC Royal Bank. Now I would like to invite Mr. John Mann, Vice President of Asian Banking in Greater Toronto, from RBC Royal Bank to come up the stage to say a few words. John?
Thank you so much, Edward, and good afternoon, everyone. On behalf of RBC Royal Bank and my colleague Paul, Edward, I think we also have a few maybe somewhere, Jeffrey, Peter, and Irene. We welcome you all to this business forum. As a company with deep personal and business ties to the Chinese Canadian community, we're so proud to be the title sponsor of this event, as well as supporting ACCE in all their effort to build a stronger Canada in many capacities over the years. Thanks to so many successful clients and friends, we have seen firsthand a vast majority of extremely talented pool of Chinese Canadian businessmen who continue to make an immense impact in the Chinese Canadian community. We have seen how they drive their ideas and effort contributed to the overall betterment of the Canadian economy and also the community. So I really hope that you'll get a lot out of the day from these extremely well speakers, how to become a winner in the field. And I want to thank everyone at ACCE in organizing this business forum. We wish you all a pleasant evening. 各位午安，王正银行很荣幸能够再次成为这个座谈会的主题赞助。我们希望今天大家有所收获，也在这边恭祝大家身体健康，工作愉快，谢谢。
I would like to invite the event's promotional partner, Mingbao Daily News, Ms. Maureen Ken, the Director of Sales and Marketing, to come up and say a few words for us. Thank you, Maureen.
Thank you, Elliot. Hello, everyone. Good afternoon. I feel very privileged today to be here because I get a chance to meet all of you up there and to be with you together to share the award, to share the success stories of our award winners today. And for the past 15 years, I have been employed to work in the sales and marketing areas in the Chinese media industry. Every day, I have to deal with many advertisers. They are from all sorts of businesses. I've learned one thing. In order to be successful, no matter if you are an employer or an employee, you should always have an entrepreneurial spirit, which is set your business goal, find your direction, plan strategically, and take action. So I'm very delighted to have another opportunity later today to participate in one of the group sessions to discuss with you about how to market your business to the ethnic groups. I look forward to seeing you in that group session and sharing my experience in the sales and marketing. And last but not least, I want to thank ACCE on behalf of Mingpao to having us to be a working partner for 16 years. It is our honor. So thank you very much, and I look forward to seeing you guys later. Thank you.
Airline sponsor, Cathay Pacific Airline, Mr. Ross Corman, the General Sales Manager of Eastern Canada. Ross, please.
Thank you, Elliot. Good afternoon, everybody. On behalf of Cathay Pacific Airways, we're delighted to be a sponsor for this afternoon's business forum. I'm especially delighted to see some of the past winners here because I know many of you aren't on the ground very often. You're traveling doing business, and we very much appreciate it. Business is an integral part of Cathay Pacific's overall strategy, and as Ellen alluded to, tough economic times coupled with $100 a barrel gas makes business model pretty tough these days, but we do appreciate our customers' continued support, and we continue to invest in our product. We have specific programs designed for small, medium, and large enterprises, and details of those can be found on our website. We've also got a special offer for all attendees at today's session, ACCE members included, to trial our newest product. Even though the business environment is tough, we continue to invest in brand new products. We've recently introduced an enhanced business class product flatbed service. We've also improved our economy class seat with a brand new seat design. And our brand new product that we've introduced especially for small and medium enterprises who may not be able to have the budget yet to buy business class. We have a brand new premium economy product, which is a definite step up from economy class, and that's the special offer we have available. For details, you can take a look at our table outside the hall. And once again, on behalf of Cathay Pacific, we're delighted to be here. We wish you all a very educational and enjoyable session this afternoon at the Business Forum. Thank you.
Okay, thank you.
Now it is the time for us to learn about what is the economic outlook for Canada in the coming year. I would like to welcome Paul Farley, Assistant Chief Economist of RBC Royal Bank, to share his view with us. Before that, let me do some briefing or share some background of Paul. He is an Assistant Chief Economist. Paul is responsible for the analysis and forecasting of macroeconomic and financial market development in Canada, the United States, and key overseas economies, and is a regular contributor to a number of RBC publications. A graduate of Queen University and University of Manitoba, Paul joined the Economic Department of RBC in 2007 after working for 20 years at another major financial institute where he was responsible for generating the macroeconomic outlook for the United States, Canada, and Canadian regional economies. Paul started his professional career as an economist in a research development at the Bank of Canada. Paul is a member of Economic Policy Committee of the Canadian Chamber of Commerce and former member on the editorial board of Canadian Public Policy. Paul is also past president and director of the Toronto Associate of Business and Economics. Let's welcome Paul from RBC Canada.
Thank you, Edward, for the introduction. What I'm going to provide to you this afternoon, this afternoon, we've just made it the afternoon, is RBC's outlook for the North American economy. And I'm going to spend some time in terms of what our expectation is for the U.S. economy. And with that, I'll touch on sort of the global outlook. And from there, look at the Canadian economy, both in terms of the economic outlook and some of the challenges that the Canadian economy is facing. And with that, sort of making the argument in terms of the importance in terms of forums like this, in terms of enhancing not only the economic and personal sort of contribution and prosperity, but also for the country as a whole, as John alluded to in his comments. The title of the presentation is Navigating Through Challenging Times, and certainly sort of what we went through last week, and Friday in particular, is sort of making the case in terms of the challenges that we continue to face. Our bottom line view is, though, that the recovery will continue, that growth will continue through the medium term, though the pace will be gradual. And in terms of the tagline that we're using for the U.S. economic outlook, the gradual pace of recovery leaves the U.S. economy vulnerable to possible negative shocks, gives the indication of what the risks are when you talk about sort of a gradual pace of recovery. It keeps the unemployment rate a bit on the high side, and high unemployment usually maps to confidence not as robust as what you would like, and therefore vulnerable to negative shocks playing out. And those negative shocks can be political. Outbreaks of major military conflicts are sort of a risk out there in terms of derailing the recovery, but also financial market risks. And at the moment, that is where the main risks to the sustained recovery are at the moment playing out. I'll move back here. In terms of recent developments, in terms of the U.S. economy, we have seen 11 quarters of growth since pulling out of the recession in the middle of '09. There was a bit of a pause early part of 2011, but that pause looks to have been temporary. Activity bounced back through the remainder of 2011, early in 2012. But it's still the case that the pace of recovery is fairly gradual, and what that implies is that the unemployment rate is higher than one would like to see. As you can see from this graph, even though we've seen a bit of an improvement in recent months, the level of unemployment in the U.S. still well above the pre-recession lows. And that's where the vulnerability in terms of this recovery resides. That still high unemployment means confidence isn't as robust as what you would like to see, and vulnerable to various negative shocks, moving agents, businesses, households onto the sidelines. And the main risk that we're confronting right now is European sovereign debt. Bottom line, there's a number of European economies that are operating with too high debt levels. Concerned those debt levels are so high that the sovereigns will not be able to continue to service the debt. Then that leads to sort of concern about who's holding that debt and what damage it'll do to their portfolio if these various sovereigns fail to make payment. Now, the bottom line solution in terms of these pressures is to keep injecting liquidity into the system, to keep money flowing through the system, to provide the means for various entities to continue to make good in terms of servicing the debt. However, to do that, the various officials in Europe, where the largest problems reside, is the demand that fiscal restraint measures get put in place to make sure that we don't go back to a period of these high debt levels. And so there's various demands in terms of economies such as Greece, Italy, Spain, Ireland, to enact fairly disciplined sort of fiscal policy to rein in the spending. And at the moment, that's where a lot of the risks reside. That these sovereigns back away from these commitments to sort of rein in the fiscal balances. And if that were to happen, there's a risk then these injections of liquidity will get put back, and we get sort of a messy outcome. Our bottom line view is, though, that there will be enough commitment to fiscal discipline demonstrated by the sovereigns, that the injections of liquidity will continue by the European officials, and that will allow the recovery both globally and in North America to continue. Make no mistake, though, there are risks out there. There is the risk that you don't see these commitments being maintained, and with that, you could start seeing sort of the cutback of these liquidity injections, which could well trip up the recovery. Not our base case, but clearly there's that risk out there. Base case is these injections of liquidity will continue. There'll be a sufficient demonstration of fiscal restraint that the European officials will see their way clear to keep injecting liquidity into the system, allowing financial markets to continue to operate. But it is the case that sort of European sovereign debt is now the so-called new toxic asset. The previous one that sort of prompted the last recession was the subprime mortgages. There was concern about who was holding subprime mortgages. In the current environment, the concern is who's holding European sovereign debt. Now, during the subprime mortgage crisis, it was the cost of capital moved up. That tripped up the global recovery. And the graph that's in front of you right now is showing you the two main channels of which that cost of capital moved up during the subprime mortgage crisis. The one on your left, the equity markets, they tanked quite precipitously. That resulted from investors getting concerned about exposures of certain companies to subprime mortgages. Hesitancy to provide funds, equity markets moved lower. So companies issuing stock were getting less funds for their issuance, cost of capital went up. The second channel is kind of a lending spread type graph. What that's meant to suggest is, as concern about counterparty risk emerged, because of holdings of subprime mortgages, lenders are asking for a higher return to protect themselves against that risk. And so lending spreads widened out quite precipitously. The actual ratio is a LIBOR rate, wholesale cost of funds, versus kind of a risk-free government interest rate. Most of the action is on the LIBOR rate, the wholesale cost of funding. As that became more expensive because of concern about exposure to subprime mortgages, that went up, the lending spreads widened out. That spike on that graph, that was the Lehman Brothers bankruptcy. Because at that point, there was concern that the financial system could well shut down, and those spreads just jumped dramatically higher. But this graph also shows that the pressures this time around with respect to European sovereign debt are not that great. We are not seeing sort of the big leg down in equity markets. We're not seeing dramatic widening in spreads. Where we are seeing it is in Europe, and that's because there's concern about European banks holding of European sovereign debt. But as you can also see from that graph, that pressure has started to ease. You're getting aggressive introductions of liquidity into these European markets to contain those cost pressures. And to date has been successful and is giving us confidence that we will not see another cost of capital spike or shock similar to what we saw during subprime mortgages. But we are watching these markets very closely. A massive leg down, similar to what we saw in 08, would raise concerns we're seeing another cost of capital shock. Similarly, a marked widening in spreads, again, would raise concerns that we're going through a similar type shock. Evidence to date is that policymakers are fairly successful in terms of containing those pressures. And at the moment, we are not seeing evidence of another cost of capital shock playing out. And with that, that's part of the reason why we're confident that the expansion will continue. It won't be derailed. Now, the other area that people are watching, and this is sort of what caused all the problems in financial markets yesterday, are employment and growth in jobs in the U.S. Those job growth are key to keeping household spending both on consumer goods and housing. And as this graph shows, and this doesn't unfortunately reflect the data that came out yesterday, but we had been seeing a bit of a downward trend in recent months. That data that's on that graph is through April, and we saw a weakening in employment growth in April and March. The data yesterday unfortunately indicated that that slowing trend has continued in May, and quite dramatically, going under sub 100 in terms of a payroll number. That has raised concern that labor markets are faltering. And with that then could contribute to the U.S. falling back into recession. Now, our inclination in terms of reading the data right now is that what we're seeing, even through May, is a bit of a payback from particularly strong numbers through the winter that reflected very mild winter weather and temporarily boosted employment. So we were getting overstated employment gains through the winter. We're seeing a bit of a payback right now. That said, as we get into June and July, these numbers have got to start picking up. They slow further, it will just sort of aggravate this concern, enhance, abet this concern about the U.S. slipping back into recession. But it was this data that contributed to the marked weakening that we saw in equity markets. And it's an indication of just the nervousness in terms of financial markets. They know they're looking at a gradual pace of recovery, and they don't want any kind of shock playing out, be it through financial markets or indications that U.S. firms are not hiring. Our view is, though, that the slowing that we're seeing in employment will prove temporary, and as we move through the summer, these employment numbers will start bouncing back, and with that, it will sustain the recovery in the U.S. In terms of growth rates, after 1.7% increase in 2011, we're expecting growth this year of 2.5%, 3% next year. But it's contingent on financial market pressures being contained, and employment growth in the U.S. Starting to rebound from some disappointing numbers. So that's the context in terms of the outlook for the U.S. economy. Now I'll turn to our outlook for the Canadian economy. Tagline that we're going with for Canada is strong demand for natural resources, a benefit for Canada, though growth is still largely dependent on a sustained U.S. recovery. What I'm trying to get at there is that first part of that comment. There's actually a positive shock playing out in Canada right now. It's these high natural resource commodity prices. Canada's a major producer, major exporter of a number of natural resources. So when we're talking about high prices, that's a boost to export revenues. It's a boost to Canadian incomes. That is helping to support the Canadian economy. However, the dominant pattern of growth in Canada will be determined in terms of what we see in the U.S. So when we're talking about a gradual pace of recovery in the U.S., that will largely inform the pattern of growth we'll see in Canada. Gradual growth with a little bit of a boost coming from these natural resources. But this natural resource price or commodity price shock has implications for the exchange rate and the regional outlook that I'll touch on in a minute. Now, in terms of what's been going on in the Canadian economy, it's generally the case that growth in Canada has been slightly stronger than the U.S., other than the second quarter last year, where we actually saw a decline in economic activity. As you can see from that graph, that weakness was temporary. The feeling is now that it was just a confluence of a number of negative factors. The natural disasters in Japan hit on auto production here in Canada. There were wildfires in northern Alberta that resulted in production of some oil sands facilities being shut down. But those pressures passed, and with that, growth bounced back. And it's been generally the case that Canada has been growing slightly stronger than in the U.S. And that's a reflection of this commodity price shock, this positive shock for the Canadian economy. What's causing it? It's demand from emerging economies. And despite some weakening growth from China, from India, from Brazil, the growth, in our view, remains sufficiently strong that it will keep commodity prices high, that this positive shock will continue. It won't dominate the pattern of growth in Canada, but it will provide a little bit of additional lift to economic growth here in Canada. And our view is that support will continue. This isn't a fashionable sort of notion that we'll forget about in 6 months. The feeling is this is a real structural change going on in the Canadian economy. But it is contingent on demand continuing to be their rise. The pace can moderate, but still that demand continues. We still see, growth in economies such as China in a range of 6 to 10% continuing through the medium term. And with that, it will, in our view, generally keep commodity prices historically high. Now, it's not going to be every commodity price that will benefit from it. And as well, commodities will continue to be buffeted by supply-side factors. But in the main, most commodity prices will benefit from this increased demand from emerging economies. We're seeing evidence of it in oil prices, we're seeing it in grain prices, we're seeing it in base metal prices. And yes, they still fluctuate, and we're going through a period of some weakening at the moment. But basically, if demand continues from emerging economies, it will be the case that most commodity prices will remain historically high. Now, forestry prices have not been benefiting as much. In part, we're seeing increased production capacity coming about within some of those emerging economies, such as Brazil. Lumber prices are remaining weak. That's a reflection of the weak U.S. housing market. But we're seeing some evidence that that might be starting to turn around. Still very weak levels, but it does appear we're seeing a bit of a turn in the U.S. housing market, and that may provide a bit more support for lumber prices. Natural gas prices I don't have on that graph, but they as well are staying weak. That's a reflection of increased supply coming about in terms of natural gas. It seems like every time we turn around, we're seeing another shale gas deposit being discovered. That in conjunction with a very mild winter here in North America, reducing demand, has been weighing on natural gas prices. But in the main, our view is commodity prices will generally remain historically high. Now that supports the Canadian economy because it provides a boost to export revenue, so it's an income boost to the Canadian economy. But as well, it's contributing to strong business investment as firms try to increase production capacity. So the high oil prices is resulting in increased investment in the oil sands area of Alberta. High potash prices are contributing to increased production facilities in Saskatchewan and to a lesser extent New Brunswick. So we're seeing firms respond to these higher prices. And basically our view is capital spending will remain a main driver of the Canadian economy through next year. We've got business investment growing at around 7%, so that's more than double the run rate in the economy, which I'll show in a moment is running at around 2.5%. So business investment is responding to these higher commodity prices and will be a main driver of growth in the Canadian economy. Now when we turn to households, the news isn't as bright. The concern there is high debt levels being carried by Canadian households. This graph has gotten a fair bit of publicity. The Bank of Canada has been talking about it quite a bit. Their concern is through the last economic downturn, debt to income in Canada generally trended higher. Often in a recession, you see the debt measures move lower. It didn't happen in Canada. It did in the US, as that graph showed. Didn't happen in Canada. And so the concern is that debt load so high that it will prevent households from spending, keeping consumers spending on the weak side. Now, one offset to that is that interest rates are very low at the moment, and as a result, it's keeping debt servicing very low. So that's despite sort of the high debt levels. When we start looking at how much money needs to be spent to service that debt, it is not particularly high. So at this point, with interest rates being on the low side, the high debt levels, in our view, is not posing a major impediment from households to spend. Now, interest rates at some point will go up, and I'll touch on that in a minute, but the increases are, in our view, are expected to be fairly moderate. And so as a result, debt servicing, these high debt levels, will not prevent households from spending, though it will keep the pace fairly moderate. So in contrast to business investment, we've got a growth rate more than double the run rate in the economy. In the case of consumer spending, we've got it slightly underperforming this run rate in the economy. Growth in consumer spending running 2.4% versus an overall growth in the economy closer to 2.5%. And these high debt levels, in our view, will also play out in the housing market. It won't prevent sort of increases from occurring, but it'll keep the level of activity fairly subdued. So in something like housing starts, we're expecting starts this year of 204,000, which isn't bad, but as you can see from that graph, down from pre-recession highs. So again, high debt levels won't prevent spending from Canadian households, but it'll keep it fairly moderate. Similar sort of pattern when we look at housing sales, pick up, but not to pretty robust levels, lower than pre-recession highs. Again, the impact of high debt levels doesn't prevent spending from occurring, but it keeps activity on the moderate side. Housing prices, after a bit of a bounce from the downturn through the recession, the rate of increase in our view will ease. But the high debt levels will prevent sort of the housing price bubble taking hold in the Canadian economy. So in total, continued growth in the U.S., strong business investment, consumers spending, not particularly robust, but at least continuing to spend, will allow the recovery in Canada to continue at a pace of 2.6% this year, being maintained in that rate next year, and that compares to a 2011 growth rate of 2.5%. This pace of growth will continue to put downward pressure on the unemployment rate. If you think back to the graph that I just showed you in terms of the U.S., you can see that we actually have seen more of a downward move in the unemployment rate here in Canada. Again, a reflection of growth here being slightly stronger than in the U.S. And we expect that downward trend to continue. By the end of next year, we've got the unemployment rate dropping below 6%. So a lot more progress than what we're seeing in the U.S. As you can see from that graph, we're still not back down to sort of pre-recession lows. So it's implying still some slack in labor markets. And with that, in our view, it will keep inflation low. So despite all these injections of liquidity that I've talked about by central banks, high commodity prices, The slack in labor markets, in our view, will keep inflation low in the Canadian economy. So on a core basis, we've got inflation at or slightly below the Bank of Canada's a midpoint target or mid-range target of 2%. Now, low inflation won't prevent the Bank of Canada from tightening. It hasn't prevented it from already initiating some tightening. We've seen the overnight rate move from a recession low of 0.25% to 1% currently. The Bank of Canada is on the sidelines at the moment. I think they want to assess the tightening to date, what impact it will have. I think they want reassurance that the recovery in the U.S. will continue. By the fourth quarter, we're assuming that they will have that evidence and resume tightening. And so we've got the overnight rate rising another 100 basis points through the third quarter of next year, moving it to 2%. But as you can see from that graph, 2% at the end of next year, that's historically low. That's what the low inflation buys you. It keeps interest rates on the low side. If you had an inflation problem, these increases would be much more dramatic, easily moving to 4 or 5%. But the low inflation buys you, it doesn't prevent interest rates from going up, but it keeps the tightening very moderate. So by the end of next year, rates are up, but to still very historically low levels, with the overnight rate running at 2%. So move out on the yield curve, same sort of pattern. Rates move up, but the increase fairly gradual, fairly moderate. So a 10-year by the end of next year, still under 3%, up about 100 basis points, a little bit more than that from where we are right now. But again, historically, you can see that represents fairly moderate interest rates, a benefit from that low inflation. Canadian dollar. This is one area that reflects the impact of those high commodity prices. Just as we expect commodity prices to remain historically high, that will go a long way, in our view, in forming where the Canadian dollar settles out at. And in terms of sort of talking about oil prices remaining high, our view on a WTI basis is that they will return to about $100 and stay at that level through next year. That, in our view, implies a currency at or slightly above parity. So stronger than we are right now, running below parity. I think right now there's just a lot of anxiety about the global recovery. Our view as we go through this year will ease. The Canada will start appreciating. That will continue through most of next year, moving by the end of next year to around 104 cents, so above parity, a strengthening in the Canadian dollar. The Canada will get buffeted by tightening versus Canada versus the U.S. and that little tick down that we've got there in terms of the Canada right at the end of next year. Our market's starting to anticipate a Fed tightening in 2014. Prior to that, sort of the tightening by the Bank of Canada, which we expect to start commencing fourth quarter of this year, contributes to sort of a bit of an upward trend. But in the main, it's those high commodity prices keeping the Canada high. And policymakers are trying to get that message out, that this is the new reality, that if commodity prices remain high, oil running around $100, the days of an 80-cent dollar are not likely going to be returned to. Now, if oil prices collapse, certainly that will precipitate a much weaker currency. But do you really think demand is going to fall off dramatically coming from Asia? If that is the case, then you could sort of start anticipating some weakening in the currency. But I think the feeling is that demand should continue. It will fluctuate, but in main should continue. And that will result in a currency being historically high. And that could be the reality that the Canadian economy is dealing with. Now, in terms of the Chinese currency, the feeling is it will appreciate relative to the US dollar as well, in the main keeping pace with sort of the strengthening of the Canada. So the Chinese currency, in our view, will remain relatively steady through the end of next year. Quickly touching on monetary policy, this graph is showing the government's own projections of their balance, which is their fiscal balance, which has a return to balance by the middle of the decade. This implies tightening in fiscal policy, reducing the size of the deficit. So there will be fiscal tightening over the medium term. But these imbalances aren't huge. They're much smaller relative to a number of other industrialized economies, particularly in Europe. What that finds us is there isn't the pressure from financial markets to aggressively move to tightening. We are not seeing the kind of pressure you're seeing in certainly Greece's and Italy's, but even UK or France to tighten. The pressure is just not there. So the Canadian government has a benefit because they will only tighten to the extent that they think the Canadian economy can handle it. They don't want to derail the recovery. So any hint that that's happening, they will pull back. These imbalances aren't that large. But bottom line, just as interest rates are going to have to go up, fiscal policy will need to be tightened as well. Though again, we have the benefit that the tightening can be very gradual and at a pace that doesn't jeopardize the recovery continuing here in Canada. Quickly, in terms of the regional outlook, tagline there, that all regions will benefit from continued U.S. growth. Strength in commodity prices has a varying impact across the country. The support is largely going to occur in those provinces and regions that are doing the production of these natural resources. So when we stack our expectation of growth by provinces in 2012, it's the Albertas and Saskatchewans that come up on top. Alberta benefiting from high oil prices, Saskatchewan benefiting from high oil as well. They have a large shale oil play in the southeast corner of the province, but they're also benefiting from high potash prices and high grain prices, contributing to very strong growth in that province. For a province like Ontario, when we talk about high commodity prices, we're a net importer of a lot of those commodities, so that is essentially high input costs. And you can certainly see that in terms of oil prices, keeping energy prices high. And then there's the additional kicker when I say those high commodity prices are going to translate in terms of keeping the currency high. So another challenge for the manufacturing sector here in Ontario to the extent they're exporting the U.S. market. But the strength in the U.S. economy, the strength or pickup in growth there is an important offset, and in our view will allow Ontario to grow at a not bad pace, as a graph is showing, a little under the national average of 2.5%. So that recovery in the U.S. is an important factor, sustaining growth here in Ontario, allowing it to overcome high input costs and a strong Canadian dollar. Just as a bit of a side comment, that spike in growth in Nova Scotia next year is reflecting the impact of that large frigate program that was just announced. It's a very sizable program, and in our view, will start kicking up growth in Nova Scotia next year. I'm just going to finish off, I'm going to take about another 5 minutes, just in terms of touching on one of the major challenges facing the Canadian economy at the moment. And that is a slowing in economic growth, which I'm trying to illustrate with this graph here. We have been seeing sort of a fairly steady fall off in growth in the Canadian economy. And this has resulted in part from slowing in labor force growth and to some extent some moderation in productivity. And this slowing of growth has concerns for the Canadian economy because a weakening in growth makes various social programs more difficult to finance. And this is a real fiscal challenge that the federal government is confronting. We need to do more to boost overall growth in the economy, to continue to be able to finance a number of programs that we've currently got in place. Now, one solution in terms of countering is raise productivity growth, so there are a number of initiatives to try to do that. The other channel that you can use to try to address it is to increase immigration. And so the Canadian government has been promoting increased immigration into the Canadian economy, as have most other industrialized economies that are facing similar challenges with the aging of the population, that we're seeing sort of a weakening in terms of employment levels, employment growth. And so to counter it, you're trying to bring new immigrants into the country, changing the age profile of the current population. Just as a bit of an aside, in addition to sort of boosting sort of immigration, there has been sort of a marked shift in terms of where immigrants are coming from Canada. Earlier decades, it's largely from Europe, but we are increasingly seeing increasing share coming from Asia. But what is of concern at the moment is that Canada hasn't done as a good job as it needs to do in terms of fully utilizing the ability of recent immigrants. And that's kind of the importance of sort of gatherings like this to try to counter this. And this just isn't sort of, people being nice to sort of try to raise sort of output productivity in terms of new arrivals into the country. It becomes very important in terms of funding various social programs. That we start enhancing, raise productivity of new immigrants into the country so that they are fully utilizing their skills. And we have been seeing sort of a worrying trend that as immigrants come in, their earnings are significantly lower than sort of resident Canadians. Now, part it's sort of losing or learning sort of the rules, so to speak. But the gap has not been closing as quickly as what we've been seeing in other ways of immigrants into the country. And as well, unfortunately, the unemployment rate has, for new immigrants, been markedly higher than sort of resident Canadians. Now, part of it can be accounted for varying skill levels. But some analysis that we've done at RBC argues that that doesn't explain away all the gap. That there is sort of the issue in terms of better utilization of skills of immigrants when they come. It is not happening, and it's not happening as effectively as it has in earlier decades. And there is the importance in terms of trying to make sure that as immigrants come in, the skill levels that they bring with them, that we're able to fully utilize them. And I stress, this isn't sort of someone being nice in terms of saying that. It becomes very important in terms of the performance of the Canadian economy, in terms of funding various social programs, that anybody that we're bringing into the country, we want them to operate as high a level as they can to keep sort of that output increasing and hopefully raising it to sort of a higher growth rate, that we can counter the impact of a current aging of the working age population here in Canada. And as I mentioned, it's sort of gatherings like this, opportunities to hopefully counter sort of the trend that we've been seeing to date, and sort of go further in terms of making sure that new immigrants to the country are able to fully utilize their skills that they bring with them and help boost sort of growth in the Canadian economy. And with that, I'll end the presentation. Thank you.
Please make sure you turn off or the silent mode. Please turn the cell phone in. And every year, the ACCE, Association of Chinese Canadian Entrepreneurs, will organize an award gala to recognize the successful entrepreneurs. Today, we are going to have 4 award winners for the Chinese Canadian Entrepreneur Award. They are not only successful, they are also very generous to share their successful story with us. So later on, we have a volunteer to pass on everyone a look back. In the back, you have paper and pen. Please write down the question that you would like to ask and pass it along to the front. If you have a particular question to ask our speaker, the successful entrepreneur here, please write down your question. And without further ado, let me introduce the moderator of the following panel discussion. Sandra Tam is our ACCE director. She's going to moderate the panel discussion about the success story of our entrepreneur.